Hello, Scott Vance here from Tax Vanna. I'm just going to give you an update on the One Big Beautiful Bill, which just passed. Today's July the 6th. It passed 2 days ago on July the 4th. What I'll do is just give you a brief overview of the tax changes and their effects on you as the individual taxpayer. Hope you find this informative, and if you have any questions, feel free to reach out to me. My website's www.taxvanta.com. My email is scott@taxvanta.com, which I will include below in the notes. And if you have any questions, feel free to schedule a time. Here's a summary of the 8 key provisions that I pulled out of the One Big Beautiful Bill that affect individual taxpayers. What we'll do going further is we'll go into each of these specifically and talk about the specific requirements of each and pitfalls potentially that may be in each of them. But probably number 2, the deduction for tip income, I get asked about the most. So a couple quick key things to remember about this is this is a tax exemption of up to $12,500 of income for a single person or $25,000 of income for a married person. But that tip has to come in the form of cash. So for a waitress example who completes her service, she gives the patron the bill, and the patron pays the bill with cash, and then includes in that cash a tip. That tip is reportable by that waitress, and that income from that tip up to $12,500 is excluded from income. Now, say the same situation: waitress brings you the bill, the patron pays the bill with a credit card and includes the tip on that credit card. Well, there is no allowance, no exemption of that tip income if it is paid with the credit card. So that's one of the pitfalls, and we'll talk about that more going forward. So the first item we're going to talk about is the SALT cap increase. SALT stands for state and local tax. And in 2024, on your itemized deductions, you are limited to a $10,000 max of state and local tax itemized deductions. This especially affects those with real estate that have taxes that are really high, and then also high state and local taxes, as most people would very quickly max out that $10,000 limit, and then the additional amount would not be allowed to be included as your itemized deduction. So the way this is going to work, like I said, traditionally in the past it was limited to $10,000 of a limit on the itemized deduction. But for now going forward, below $400,000 of income, you'll be able to deduct up to $40,000 of state and local taxes as part of your itemized deductions. Now this phases out from $400,000 to $500,000 for higher income people, and then at $500,000 of AGI, the deduction is fully gone. Now, one interesting thing here is there's a retroactive option. The IRS has not obviously flushed this all out, but the rules say that you'll be able to go back to 2022 and 2023, making this a retroactive tax change. So we'll have to looking at your tax returns to see if that helps people, and if so, filing the amendments. And I'm sure as the IRS works through this, we'll get some guidance as to how that's going to work and what information we're needed. And then just to avoid double dipping, which is kind of said without being said, is the taxpayer must choose between itemizing using the SALT or using the standard deduction, not both, which is almost doesn't need to be said, but I guess it does. So basically, you choose the better of the standard deduction without the SALT. The second item on my list of tax changes that affect most taxpayers is tip income. So people that are eligible to take this deduction on your taxes for tips can deduct up to $25,000 in reported tip income on their federal tax. So this applies to people that are generally tipped occupations, so servers, bartenders, hairstylists, and it phases out if your income on single if you make more than $150,000, and for joint filers who make over $300,000. And the key thing to remember like this on the tip income, like I said, is only cash tips that are reported to employers and the IRS are eligible. So if you have non-cash tips and digital tips, like with a credit card, those remain taxable. So again, so if you're a waitress and you bring your bill to the patron pays with cash, and the tip is included in that cash, then you have to report that cash to your employer and ultimately the IRS for it to remain exempt from taxes. Now, in the similar circumstances, the waitress brings the patron the bill, patron pays with a credit card, and in that credit card bill is the tip. That tip is not exempt from taxes, and it will be reported as such. This will have to be reported, obviously, through the W-2, so there's really no action to take on your part other than if you get paid a tip with cash, you have to report that. You've always had to report that, but now you have to report that to take advantage of the deduction or credit issue. So eligible employees can deduct up to $12,500 if you're single, or $25,000 if you are married filing jointly. So this applies to non-exempt employees under the Fair Labor Standards Act. Generally, that means that they're typically hourly employees. It phases out from $150,000 to joint filers, or excuse me, $150,000 for single and $300,000 for joint filers. It's applicable to overtime pay. So the way it is read is it's only compensation that exceeds 40 hours per week. So as I read it, as I understand it, you have to have 40 hours of work, and then that 41st and beyond hours are the hours that you're able to take advantage of this. So for example, say you were a person working a 12-hour shift on the first day of the week, say a Monday, and then so your 8 hours is straight time, and then those 4 hours are overtime. Now, say you only work that Monday. For whatever reason, you don't work any other additional time, but you still get those 4 hours of overtime because you're over the 8 hours. Well, if I read what the One Big Beautiful Bill says and apply it as I understand it, only the 8 hours, or excuse me, those 8 hours would be standard time, and then those 4 hours, even though they're paid to you as overtime, do not count for this. So you have to hit the 40 hours. Again, the IRS will read through this and issue further guidance, but that's kind of the way that I look at it right now. And the last thing is, obviously, just like the tax income, or excuse me, the tip income, this will be reported through your W-2. They'll have to add some information to the W-2, so it should be just a matter of you turning that W-2 in to complete your taxes. The auto loan interest deduction. So taxpayers are allowed to deduct up to $10,000 in interest paid on qualifying auto loans. Some of the qualifications are it has to apply to a passenger vehicle, and it has to have been assembled in the United States. I'm assuming that as the IRS goes through and starts to read through this, they'll start issuing lists of vehicles that this is applicable to, similar to what they did with the electric vehicle credit that they used to have. So it's an above the line deduction, so it's available to you whether you're itemized or not. And it does phase out, so it phases out for single people earning over $100,000, and then joint filers earning over $200,000. And it is only for vehicles purchased in 2025 going forward, and it has to be a new vehicle. And lastly, it kind of has to be said is this deduction targets the interest payments only, but not the principal. So if you say are paying a $600 note each month for your car, it's not going to be the whole $600. It's only going to be the interest part, which may be half of that, just depending on your interest rate. Child tax credit increase. So basically, the key thing here is the child tax credit goes from $2,000 to $2,500 per child for basically a child that's under the age of 17. The refundable portion, which mostly affects lower income taxpayers, remains at $1,400. So if you're taking advantage of refundable credits and your taxes, it probably means no change to you. One thing to understand is something that's changed is both the child and the taxpayer and the spouse, if married filing jointly, have to have work eligible Social Security numbers. In the past, all that was needed was the ITIN, which is the individual tax identification number, to the parents. And actually, I don't think as long as one parent was good, the other parent could not have a social number or an ITIN. And then just so that it phases out for single filers over $200,000 and joint filers making more than $400,000. So the enhanced senior deduction, this is another big thing in the news. People saying that, well, now they're going to not tax Social Security. Well, in fact, at this point, I think as of filing 2023 tax year, I think only 64% of people, I think 64% of people who had Social Security income did not pay any income tax on that income. So and then I think with this additional deduction, it goes to something like 80% of people will not pay taxes. See a jump of about 20%. So it doesn't affect as many people as they think. So basically, it's a $6,000 senior bonus deduction. So what it is anybody over 65 can claim an additional $6,000 deduction on top of your existing deduction. So this is what we call above the line deduction, meaning you get the $6,000 deduction whether you're itemized or you take the standard deduction. And married couples can double the $6,000 deduction to a total of $12,000. There is a phase out, so from $75,000 of a modified adjusted gross up to $150,000, it phases out, and then it phases out at a rate of 6%. And it doesn't necessarily eliminate taxes on Social Security benefits. It doesn't really have anything specifically to do with Social Security, but it does increase the amount of deduction, which through the various tax things gets to reduce that tax on Social Security if you're taking it. Energy efficient credits. So recently, energy efficient credits were used. There's two different basically main parts. So there's energy efficient home improvements. So this would be things like new windows, new doors, improved heat pumps, things like that. That was a credit that was allowed, but it's effectively, they're ending them is what they're doing. They have decided that energy efficient anything is not allowed. So anyway, the way it's going to end, so energy efficient home improvements, if it's purchased in 2025, you'll be able to claim them on the 2025 tax return. But after December 31st, 2025, anything purchased will not be eligible for that credit. The electric vehicle credit is a little bit different. You can still claim the credit on your 2025 for eligible vehicles that were purchased, but only up until the 30th of September. So you'd be able to use that credit up till vehicles that are purchased up until the 30th of September for the tax year 2025. So the qualified business income deduction, probably not a very common one that most people realize, but this affects people with small businesses on the side. It was set to expire in 2025. It's now been made permanent and provides a tax relief for small business people. The main thing is the tax rate the deduction rate increased from 20 to 23%, and then also they expanded some of the eligibilities. So in the past, people that worked in law and accounting and consulting firms were not eligible. Well, now they are. And the other big thing for this is for people that have small businesses, they've now created a minimum deduction of $400 who earn at least $1,000 of income from their small business. So you can see if you take 20% of $1,000 or 23% of $1,000 would be $230, but you're getting a minimum of $400 deduction. So that's something significant. So, and then also, so the wrap up. So most of these changes take effect this year, 2025. This was just signed into law and is being flushed out by the IRS. I'm sure they will issue some implementation guidelines, and as that specific information it gets issued, I'll let you know. And then it kind of almost has to be said, but the bill permanently extends tax provisions from the 2017 Act. So the lower individual tax rates that we're all familiar with now, they're in place permanently. The doubled standard deduction, which most people take advantage of, is in place permanently. The child tax credit expansion, which this bill further expands to the $2,500, is also permanent. And then elimination of personal dependent exemptions, which goes to itemized deductions for things like unreimbursed employee expenses. Those things are made permanent as well. If you have any questions, feel free to reach out to me. You can set up a time to chat and answer any questions you may have.